Thank you very much, Tom, and thank you everyone for coming along today. Now, there's been a number of copper presentations at this event. I'm really going to focus on the China side. I'm going to talk about some of the trends we're seeing there. We'll talk about how China's playing into some of the longer-term demand trends that we expect to see in the copper market over the coming years. It's interesting, things are changing a bit. I mean, China's always helped on the demand side of commodity markets. Now we're actually starting to see them help on the supply side as well. The clampdown on the private sector mine industry in China is removing some of the elasticity on the supply side. Even this year, Chinese demand has exceeded expectations. I'm sitting there having to up my Chinese demand forecast for this year. And that's despite the fact we've got clearly a lot of pressure, a lot of fears over trade friction. As for now, China's looking after itself, and I'll talk about that. Obviously, there's a lack of new supply projects out there. The project pipeline is very lean. And then if we look at the demand side, we're going to talk a little bit about the copper-intensive global trends we're seeing, renewable energy and electric vehicles. First of all, I mean, let's put it in context. Global industrial production. Now, this is still the key end driver of many commodity markets. Actually, this year is going to see the best global industrial production growth since 2010. So we've been a pretty healthy stage, and we're now almost 30 months past the nadir in commodity prices. China, of course, led the way in terms of the recovery, then everyone else started joining in. I would say, though, we're kind of past the peak growth rate there. I would say the global industrial output growth in terms of the growth rate peaked in the fourth quarter of last year, and now we're starting to see things trend down. Quite frankly, if I'm a purchasing manager, and we've got the global PMIs up there on the right-hand side, I'm a little bit less confident than I was 3 months ago, given what's going on in the world, given the escalating trade frictions that we're seeing. But we're still growing. All the major manufacturing PMIs are still expansionary. We're just growing at a slightly slower pace. So the second derivative, in this type of environment, commodities more generally, pricing tends to be flattish, generally. We've had the big push. We've had the encouragement to get all the potential supply in the market. Now we're kind of stagnating a little bit, but we're still growing in terms of the demand side. Fundamentally, I mean, that's certainly helpful. Now, I said I was going to talk about China. I mean, it's always good to remind yourself of where we've come from. And if we look at the left-hand chart there, I mean, China's copper consumption is 6.5 times higher than it was in 2000. That's a huge growth rate. And we're now looking this year, we are set for just under 50% of global copper consumption taking place in China. So quite frankly, if you get China right, you'll get the copper market right, and you'll generally go a long way to getting metals and bulk commodity markets right. On the demand side, we've seen China grow. We've also seen them grow refined capacity. China's been the largest producer of refined copper for a number of years now, and they've effectively tripled their market share in this area. Now, what's interesting, compared to some of the other metals up there, you look at aluminium, China's 58% global share of refined production. Steel, when we've got record steel output in China at the current time, they're about 53, 54. Copper, we're still trending about 40%. It's interesting. You see, I don't have this going forward. I'll talk about that a little bit more in further slides. But I think this dominance of addition of global refined capacity may be coming to an end. If we look back again over time, you see the long-term trend in global copper consumption growth. It's actually been quite consistent. If you look at absolute numbers, we've seen that consistency. But of course, that grey bar there is China. That really has been the dominant factor. The world ex-China is actually consuming slightly less refined copper than it was over in 2000. Of course, much of that reflects the production of copper-containing goods in China, which are then perhaps exported elsewhere. But even if you look at the coming period, I mean, or the current period of 2015 to 2020, and going forward, we expect still good demand trends coming through. And it's interesting, if I put up this right-hand chart for steel, it shows a slightly different trend. Steel, we've seen a lot more cyclicality in the penetration element. Now, for commodity demand, population gives you annuity. That's been this nice steady trend over time. That's your capita part of the kilogram per capita. Then you look at penetration. And despite the substitution that we all know is taking place in copper, over the long term, we've seen increasing penetration rates over time. And that's a trend we actually expect to continue, helped by some ongoing trends. Now, let's bring it back to the current. A lot of concerns at the start of this year. Is China going to be okay? I mean, we've had 2 years of pretty strong China-led recovery. Quite frankly, I expected ex-China to lead the way in terms of demand growth this year. What I put up here is Q1 2018 Chinese real demand, so after adjusting. So production plus net trade plus change in inventories, there. Chinese copper demand is up 11.6%. Even if I take that through April, I'm still getting it plus 10% year on year, plus 10% copper demand in China year to date. And if we look at inventories, the end Q1 inventory level was the lowest we've seen in recent times. And in fact, the build in inventory, you always see a build in Q1, that's the weakest period of copper demand for the year for China, was the lowest also we've seen in recent times. We have had a pretty strong pull on copper demand this year. I've been facing a lot of questions over the past month. Isn't China's state grid spending weak? They're 23% down on where their budget spend should be. Well, I don't disagree with that. They're certainly down on their budget spend, but they're definitely still spending money on copper. If you look at utilization rates, that things like wire and cable fabricators, they're running well above 90%. They're all citing strong orders from the Chinese state grid. So copper demand, both from the grid side, from the air conditioner side in China, looks actually pretty decent. What's played into that a little bit? China's lowering scrap imports. China's basically offshoring its direct use scrap industry. The clampdown on Category 7 scrap imports that was talked about at the tail end of last year has certainly had an effect. And even though, say, well, the market's adapting, of course, commodity markets naturally adapt. What we have seen is it come to the numbers. We're expecting 20% drop in copper contained in scrap imports coming into China this year. When you don't have that scrap coming through, it means a bigger pull on refined cathode. And that's what we've seen this year. This is why we're seeing an acceleration in Chinese demand growth rates. You're seeing, I'm looking now for plus 6% Chinese cathode consumption in this year. What is interesting, of course, I mean, even over the weekend, you've seen China's State Council talk about bringing a full scrap ban across all metals by the end of 2020. China's going to up its domestic scrap consumption pretty aggressively over the coming period, but I still don't think it's going to be able to offset that fully. It is going to cause some distortions in global metals markets over the coming period, but you are seeing a bigger pull on refined metal to displace scrap use. Okay, let's talk about the Chinese business model in copper. And it's pretty clear in my view. Over time, if there is more concentrate available, Chinese smelters will buy it. And over time, you'll see less cathode come in, if at all possible. Here's share of Chinese copper unit imports, and you've seen how concentrate has continued to grow. As we've had the mine supply reaction over recent times, this push to take more concentrate in, and less is coming in refined form. Now, of course, this year, as I say, scrap is falling, but there's that clear trend to concentrate. China's now taking in more copper in concentrate than it is refined copper. That is the key to the equation. It is the Chinese commodity business model, as we've seen over recent years. Buy the raw materials, have more than enough process capacity, and ideally export a little bit of the finished good back. And in this, it's more copper-containing goods as an inflation hedge through the cycle. That trend is certainly continuing. Therefore, concentrate availability is the most important thing for the Chinese copper industry. And this is why, if we see concentrate tighten up, it's China that tends to have a problem. And that's been accentuated, I would say, in recent times. Now, of course, China went, as it grew its copper consumption, domestic mining also reacted. And we saw China go to, at one point, it was the second largest copper miner in the world, about 1.6 million tons. It's now been surpassed by Peru. But in recent times, what you've seen is a pullback here. China was cutting capex, if you want, in the mining industry before the rest of the world was. And we've seen fixed asset investment in non-ferrous mining trend negative. Now, that is, of course, not just copper, but certainly copper has taken a part of that as well. So we think this will continue. We're seeing a big clampdown on availability of financing to private sector miners in China. It is more power back to the state, and the environmental hurdles that they have to jump through or have to clear are that bit higher than they were before. Every mine in China now is having to, round the clock, report back tailings dam pressures, effluent emissions, airborne emissions back to the MIT. That is a big capex spending for a private sector miner. it is also a big operating cost because they get fined if they're exceeding legislation, exceeding standards, or if their control center goes down. Now contrast that with what's happening in smelting. China's adding an awful lot of smelter capacity. Now, too much, I would say. Given that we're expecting a tighter copper market over the next couple of years, there's going to struggle to be enough concentrate available to feed these smelters. What should happen? All other things being equal, you'd expect treatment charges and refining charges to go very low under that environment. That would make the Chinese smelters unprofitable. Now, what we've seen in other industries, Chinese government don't like it when an industry is loaded up on debt to build new capacity and then don't make money. We've seen it in steel, we've seen it in aluminium. Now, China's, yes, still a net importer of copper, but we do see a situation where probably during next year, during 2019, you see China go to 1 in, 1 out for copper smelting capacity. Doesn't change my copper forecast, but it does change my revenue share. I think they will basically backstop treatment and refining charges at a slightly higher level than might have been expected otherwise to keep that smelting industry profitable. That is one thing I would certainly advocate looking out for over the coming period, because this growth in smelter output isn't being matched by concentrate supply growth globally. Coming on to the demand side. So copper's pretty well exposed to some of the demand, if you want. The sectors that are coming through are more copper intensive, and electric vehicles is one. That left-hand chart looks at EV charging stations globally. Now, China's already leading the way in terms of that left-hand axis, the number of public charging stations that are available. But if you look at on the right-hand axis, which is the penetration, it's still down here, well behind the industry leaders, if you want, of Netherlands and Norway. Those big plans. State Grid is looking to up that, and this is on the right-hand axis. They're looking to go about 50% higher than current Netherlands and Norway levels by 2030. It's about 3 million new public charging stations. So there's big plans there. China's certainly leading the way in electric vehicles, and we're looking at electric vehicle penetration in China of about 25%. China's already about 60% of global EV sales, and that, of course, means copper use in electric vehicles rises by, I mean, that's a global figure, but about 1.5 million tons per annum over current levels. So that is this is all incremental, if you want, over the current base for copper demand. And then we look at the renewable energy side. So while electric vehicles are adding, say, about 1.3 million tons, solar and wind installations are actually adding more globally. Again, it's an area where China is leading the global trend, but to us, it's interesting. These are all distributed generation sources that all need to be connected into a grid. Things like offshore wind are ridiculously copper intensive and have low substitution potential. We model 9 tons per megawatt, for example, for offshore wind capacity, and that is the ongoing trend. Offshore wind, if you want, is going from about 8% of total wind generation at the moment towards 15% by 2025. And this is the big area that are giving us more confidence in the medium-term demand side for copper. So if we look at that, the copper market changes, and this is including use of direct use scrap, we're seeing some good growth areas coming through. There is some supply, and we're having to assume aggressive scrap recovery coming through. Of course, scrap is modeled as inelastic in the long term. Of course, it's very elastic to price. It's probably the most elastic mined commodity, if you want, to price in the short term. We're having to assume a lot more scrap recovery coming through. Again, less direct use, or not much growth in direct use in China. Much more, we're going to see that industry, in my view, offshore to ASEAN over the coming period. But even assuming that strong growth, we can't balance the market. We're basically looking at around a 5 million ton supply gap over that 2025 to 2030 period. I've built here an incentive price curve for copper. And you can see there that, in our view, we're going to need, of course, to move towards incentive pricing over the coming years to try and get enough projects through. This is, of course, incentive pricing is naturally utopian, but this is the area, this is the kind of level we think we should be at on an equilibrium basis, around about $7,200 a ton, in order to balance the copper market. Just to talk very briefly in the time I have left on I mentioned it earlier, copper project pipeline. I'm sure we've seen these charts before, but it is the leanest this century in terms of projects coming through, and we're seeing the ongoing trend away from mega projects. Mining companies not happy to push forward or certainly numerous multi-billion dollar capex, long lead time projects at the current time. We are seeing some mega projects come through, of course, OT Phase 2, potentially Kamoa, Chuquicamata Underground, Spence QB2. We're all in that 2022-2023 timeframe for the major ramp-up. This leaves us a gap over 2019-2020, which we think is quite hard to fill. If you look at model copper deficits, you see it coming out there, and we were talking 5 million ton deficit. That doesn't happen. Commodity markets never have ever-increasing deficits. They always self-solve, and they self-solve through price. We would expect, over the coming period, prices to go to a level where we'll start to drive a substitution. Now, that's when your copper to aluminium ratio becomes very important. I would say you get decent substitution above 3.5 times copper to aluminium price. Above 3.8 times, you get very aggressive substitution. I think we're probably going to have to head towards those levels over the coming couple of years. I view Chinese construction sector as an area where you will see substitution coming through. There is now a quality standard for aluminium alloy cabling, which allows some pressure release valve, but again, only at a higher copper price. Thank you very much for your attention today. If you've got any questions, I know we're tight on time here, but I will be around, or you can happily email me. That's where copper sits in our long-term commodity chart. But I hope you enjoy the rest of the conference. Thank you.
Stay up here.